Welcome to Breaking News to Trading Moves.
Glad to be here.
We are really thrilled to have you joining us today. This discussion is going to focus entirely on Hewlett Packard Enterprise's newly released outlook.
Right.
The headline numbers they just dropped and, a breakdown of the specific winners and losers in the market based on these results.
Yeah, exactly.
We're going to examine exactly what this means for your portfolio and the technology sector at large, looking at the raw data and the downstream effects on supply chains.
And our goal today is to really look closely at the data without getting caught up in the usual market hype.
There's a lot of that out there.
There really is. We want to establish a calm, insightful view of the numbers. Specifically, we're going to evaluate how AI demand is translating into measurable backlog and very real networking growth. Because there is so much noise regarding infrastructure spending, so we will focus purely on what the figures tell us about business realities right now, stripping away the speculation to see where the capital is actually flowing.
Let's get right into those hard numbers then, because the headline figures are genuinely fascinating.
They are.
Hewlett Packard Enterprise forecasts second quarter revenue that came in above Wall Street estimates.
Right. Their revenue rose 18%.
18%, hitting $9.3 billion. And on top of that, adjusted earnings per share came in at 0.65 versus expectations of 0.59.
Which is notable.
Very notable. Seeing an 18% jump for an established enterprise hardware giant is quite an achievement, especially in an environment where hardware cycles can be notoriously cyclical.
It is. And if we connect this to the bigger picture, the upgraded guidance tells an even more compelling story.
Break that down for us.
Well, they raised their fiscal 2026 adjusted earnings per share outlook to a range of 2.30 to 2.50.
Okay.
Furthermore, they announced their AI backlog has now topped $5 billion.
Wow. $5 billion.
Yeah. And perhaps the most prominent detail is that their annual networking revenue growth outlook was lifted to between 68% and 73%.
That is massive.
It is. That specific growth trajectory is aided largely by the newly combined Juniper business, which gives them a completely different profile in the market.
So what does this all mean?
Well,
when you see a $5 billion backlog and revenue climbing like that, how should you, as a listener, interpret the underlying health of this market? Because $5 billion isn't just a spreadsheet projection.
no, not at all.
We're talking about physical metal, silicon, cooling systems, and networking cables waiting to be shipped.
Right. It shows that this is real demand rather than just a one-off quarter. The company reported double-digit order increases across all their segments. The market is going to focus heavily on three core areas moving forward.
Which are?
Stronger networking demand, improving cloud and AI profitability, and absolute proof that enterprise and sovereign customers are actually spending capital on infrastructure.
So it's not theoretical demand anymore.
Exactly. It is committed capital. Customers are putting money down to secure the hardware they need, often accepting extended lead times just to hold their place in line.
That is the part that really stands out to me.
Yeah.
Yeah, when we talk about a backlog topping $5 billion, we're talking about orders that are placed and waiting to be fulfilled. It's an enormous queue of committed business.
Right.
It tells you that companies and governments, those sovereign customers you mentioned, they aren't just testing AI in small pilot programs anymore.
No, they are past that phase.
They're ordering the physical infrastructure required to run it at scale. Sovereign AI is particularly compelling because entire nations are realizing they need localized compute power.
Exactly. To train models on their own native languages and secure their own domestic data.
Right.
And to build on that, the physical reality of a $5 billion backlog cannot be overstated. These aren't software subscriptions you can just turn on with a switch.
Right. It's not a cloud SaaS product.
Exactly. These are massive, incredibly dense server racks that require specialized manufacturing, rigorous testing, and highly complex logistical chains to deliver and install.
And the plumbing to connect it all.
Precisely. The fact that the networking segment growth outlook was lifted to that 68 to 73% range demonstrates how critical the plumbing is for these systems.
Integrating Juniper has clearly given them a formidable position.
It really has. When a business can confidently project that level of networking growth, it signals that the broader ecosystem of data center buildouts is advancing rapidly. The data needs to flow faster than ever before, and that requires entirely new networking configurations.
So let's talk about where this capital is actually flowing, starting at the clearest positive read-through from the entire report.
Okay.
Enterprise networking and data center connectivity.
The real core of it.
Right. The specific tickers to watch here are HPE for Hewlett Packard Enterprise, JNPR for Juniper Networks, and ANET for Arista Networks. I want to dig into the why here because it's easy to just look at the servers, but the networking seems to be the real bottleneck.
It is. The reason these companies are clear winners comes down to the architecture of artificial intelligence. Every single AI build-out requires faster, highly complex connectivity.
You can't just plug these into a standard Ethernet switch.
No, you can't simply install thousands of advanced processors and expect them to communicate over legacy networks. A cluster of 10,000 graphics processing units needs to operate as a single, unified brain.
Right.
If the connection between two processors is slow, the entire system sits idle waiting for data.
Which is incredibly expensive downtime.
Exactly. Juniper naturally benefits here because it is now a core part of HPE's aggressive networking push, allowing them to bundle servers and networking gear together.
And Arista?
Arista Networks remains a very prominent pure play on high-performance data center networking, providing the ultra-fast switches that prevent those data choke points.
That concept of data choke points is crucial. Feeding a 40,000 piece of silicon data over a legacy switch is like putting bicycle tires on a Ferrari.
That's a great way to put it.
The processing power has increased so dramatically that the networking hardware, the routers, the switches, the optical transceivers converting electrical signals into light, must be upgraded to handle the load.
Right.
Otherwise, you are just burning electricity while your expensive processors wait for instructions.
Which nobody wants to do.
Exactly. That explains why companies like ANET and JNPR are positioned so well here. They sell the exact hardware required to clear those traffic jams inside the data center.
And that is the precise dynamic playing out in corporate IT budgets right now.
Yeah.
And it is why the market is paying such close attention to the networking revenue growth specifically.
Right.
It proves that the deployment of AI is broadening beyond just buying the initial compute power.
So they're building out the whole ecosystem.
Yeah, right. Enterprise and sovereign customers are now actively building out the connective tissue required to make those processors function efficiently. They realize that the networking layer is just as vital as the compute layer if they want any return on their massive hardware investments.
So if Arista and Juniper are handling the traffic, what about the engines actually processing the data?
The compute side.
Exactly. That brings us to our next group of winners, AI infrastructure and enterprise compute.
Yeah.
We have to bring up that $5 billion backlog again because it is such a concrete indicator of sustained spending.
It really is.
The tickers that jump out here are NVDA for NVIDIA and DELL for Dell Technologies.
NVIDIA naturally sits right at the center of the AI server stack.
Right.
They are the premier provider of the core compute engines driving these data centers. When a major player reports a backlog exceeding $5 billion for AI infrastructure, it indirectly validates the continued demand for NVIDIA's hardware.
Because almost every single one of those backlogged servers relies on their processors.
Exactly. As for Dell, they receive what the market calls a sympathy bid in this scenario.
Let's debate that sympathy bid for a second. Is Dell just riding the coattails here? Or is the pie actually getting bigger for everyone?
That's the real question.
Because when one company proves that a specific sector is booming, investors naturally look for direct competitors who might also be capturing that same demand. But does HPE winning necessarily mean Dell is also winning? Or are they fighting over the same contracts?
Well, investors view these results as a clear read-through for ongoing enterprise demand for AI servers, storage, and supporting infrastructure across the board.
So the pie is expanding.
Yes. The general consensus is that the overall pie is expanding rapidly enough to feed multiple hardware vendors. Because Dell operates in the same overarching enterprise hardware environment, strong numbers from a peer suggest that Dell is likely experiencing a similar tailwind in their own order books.
That makes sense.
The rising tide of enterprise infrastructure spending lifts the primary competitors in that space. Dell has a massive enterprise sales force, and if clients are calling up requesting AI server configurations, Dell is certainly capturing a healthy portion of those orders.
It's a great indicator for the health of the entire hardware ecosystem. The demand isn't isolated to one vendor-specific product line. It's a structural necessity for modern business.
Absolutely.
Now let's look at the true giants driving this macro trend. The cloud and hyperscale CapEx ecosystem. The tickers here are MSFT for Microsoft, AMZN for Amazon, and META for Meta Platforms.
These hyperscalers are expected to spend heavily on AI infrastructure throughout the year. We are talking about capital expenditure budgets that dwarf the GDP of some small nations.
It's hard to even wrap your head around those numbers.
It really is. The connection here is that strong enterprise hardware results add another piece of hard evidence that this capital expenditure cycle is successfully feeding through the entire supply chain.
Because we've been hearing the promises for a while.
Exactly. The market spent months listening to these tech giants promise they would spend billions on infrastructure. The hardware earnings we are discussing today serve as the receipt proving those transactions are actually clearing.
Right. They aren't direct winners from the specific stock move today, but they sit right at the top of this broader ecosystem. When you see companies actively deploying capital, it reinforces market confidence in the wider build-out trade.
Yeah.
These massive cloud providers are the ones creating the environments that ultimately drive the need for more servers, more networking gear, and more data center equipment.
They're laying the foundation.
They are building the underlying utility grid for the next generation of computing, and that requires an unbroken chain of spending, from the software layer all the way down to the optical cables.
And that ecosystem relies on continuous, aggressive investment. When the hardware vendors report strong guidance and expanding backlogs, it confirms that the hyperscalers and cloud providers are executing on their stated capital expenditure plans.
The spending is real.
Right. It shows the market that the anticipated spending is materializing into actual physical hardware deliveries. If the hyperscalers were quietly pausing their build-outs, we would see the hardware backlog shrink rapidly. Instead, we are seeing the exact opposite.
Okay, so we've covered the companies catching the tailwinds, but now we need to flip the coin and look at the pressure points. Let's discuss the losers.
The harder side of the market right now.
Right, starting with server makers facing tougher pricing and margin pressure. This is a crucial nuance for you to understand because raw revenue doesn't always equal robust profit.
No, it certainly doesn't.
We actually see DELL for Dell Technologies appearing again here alongside SMCI for Supermicrocomputer.
This raises an important question regarding the margin pressure within the AI server market. Building these advanced servers requires costly production processes and incredibly rapid hardware upgrades.
Because the environment is notoriously difficult, right?
Very difficult. Component costs are extraordinarily high. You are buying premium silicon from suppliers who hold all the pricing power, and then you have to package it into a physical box that requires advanced liquid cooling and massive power delivery systems.
It's a double-edged sword.
Yeah.
Yes, the top-line revenue numbers can look absolutely massive because the equipment itself is so expensive, but the actual profit left over after paying for the components, the specialized cooling loops, and the manufacturing labor can be quite thin.
Exactly. The server makers are essentially operating as highly sophisticated packaging companies for the underlying silicon.
Right. And the report highlights that HPE is actively prioritizing higher margin orders and staying flexible on their pricing, essentially walking away from deals that don't make financial sense.
Which is a very smart corporate strategy for them, but it exposes a vulnerability for the rest of the server group.
How so?
If investors decide that maintaining healthy profit margins matters more to them than raw top-line revenue growth, companies operating in this highly competitive space could face real pressure.
That makes total sense.
If one vendor is openly stating they are choosing profit over volume, the market will immediately scrutinize the competitors to see if they are doing the reverse chasing unprofitable volume just to show revenue growth.
Right. The raw demand is clearly there, but capturing that demand profitably is the true challenge for companies like SMCI and DELL.
That is such a vital distinction to make, especially for anyone analyzing these companies. It isn't just about how many servers you push out the door, it's about how much cash you actually keep in the corporate treasury.
If component costs continue to rise, or if the technology cycle moves so fast that inventory becomes obsolete, those already tight margins get squeezed even further.
Absolutely.
Let's pivot to the next group feeling the squeeze. Legacy enterprise hardware vendors with weaker positioning in the artificial intelligence space. The main tickers to watch here are HPQ for HP Inc. and IBM for IBM.
The legacy players.
Yeah, these are companies that seem left out of the current spending boom.
Well, this comes down to the rotation of capital and the reality of fixed corporate budgets. As investor attention and corporate IT budgets increasingly rotate into AI systems, networking, and data center demand, companies without direct exposure to the specific hardware upgrade cycle tend to struggle.
Because budgets aren't infinite.
Right. Chief information officers do not have infinite pools of money. If they need to allocate $3 million to buy a new AI server rack, they have to pull that $3 million from somewhere else in their budget.
So it's less about a direct negative hit to their underlying business today and more of a relative performance risk and a crowding out effect.
Exactly. To afford the expensive new data center equipment, companies are delaying the routine upgrades.
Like holding on to laptops longer.
Yes. They might force employees to use their corporate laptops for an extra year before replacing them, which directly impacts a company like HPQ. Or they might delay a legacy software integration project, which impacts consulting and services revenue for a company like IBM.
That is the reality of market mechanics and corporate finance.
It is. On days when capital rotates heavily into infrastructure, the market routinely looks for laggards elsewhere in legacy enterprise technology.
The companies that are perceived as sitting outside the current spending boom simply do not capture the same premium valuation.
Right. Investors want to place their capital exactly where corporate IT budgets are flowing. And right now, that flow is heavily directed toward high-performance computing and networking, leaving the traditional hardware refresh cycles starved of funding.
And finally, we have the direct competitors getting squeezed. Networking rivals losing share in enterprise upgrades. The tickers here are CSCO for Cisco Systems and NABL for Enable.
Cisco is a big one to watch here.
Cisco has obviously ruled the enterprise networking space for decades, so seeing them listed as a potential loser here is a notable dynamic.
The momentum we are seeing with Juniper raises the competitive bar immensely. Cisco is a direct peer, and they are now facing increased pressure as the market evaluates who is capturing the fresh momentum in enterprise and data center connectivity.
Because historically, Cisco was the default choice for major networking overhauls.
Yes, the absolute default. However, with HPE acquiring Juniper, they have created a legitimate powerhouse that can offer enterprise clients a bundled solution of servers, storage, and top-tier networking hardware, all under one contract.
That creates a formidable headwind for standalone networking vendors.
It certainly does.
And Enable, represented by the ticker NABL, is a bit more focused on software and IT operations, so the read-through is perhaps a bit weaker.
A bit, yes.
But they still sit near that same enterprise, network management, and infrastructure conversation, which means they could also feel the competitive squeeze as budgets get reallocated to the vendors with the most momentum.
Right. When the big hardware players start bundling management software with their newly upgraded networks, the standalone software operators often find it harder to justify their independent subscriptions.
To summarize the market takeaway from all of this data,
the cleanest trading message from this story is that the market is rewarding companies that can prove their demand is turning into actual backlog, networking growth, and better guidance.
the actual proof.
Exactly. The clean takeaway is that networking and AI infrastructure are the clear winners, while crowded server markets and legacy hardware face visible margin and positioning pressures. It is a market that demands proof of execution, not just promises of future growth.
It is a remarkable landscape to evaluate. We are watching the physical architecture of the global economy being rebuilt in real time. As enterprise budgets increasingly prioritize AI servers and high-speed networking, you have to wonder what happens to the routine, everyday IT upgrades that businesses might be delaying to fund these new data center purchases.
It's a question every CIO is asking.
How long can companies defer updating their basic infrastructure before that accumulated technical debt starts causing its own set of problems?
We will have to watch and see.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thank you so much for taking the time to join us today and explore these market dynamics. We appreciate you listening and look forward to our next conversation. Goodbye.
Thank you for joining us. Goodbye.